Hi, and welcome to my personal finance course. I'm Tom Mihawk. This is the seventh chapter in this personal finance course. It's called Credit Source, Choices, and Debt. That's a little bit of a tongue tire. I was going to call it Choices of Credit or Sources of Credit. You get my point. I wanted to lead though with credit. So, credit, source, choices, and debt. First, I want to let you know that you've heard me refer to a little bit in the previous chapters. Just about a week ago, I published a book at Amazon called Optimizing Your Resume. Here's, in fact, manuscript for it, and just in ebook form. But today it hit number 8 in its category for a moment. I mean, it didn't last long and moved down to, I think, 14, but it hit number 8 in the job hunting resumes section in category, and hit number 1 in hot new releases, which is amazing. I'm thrilled. I mean, I don't know how long it'll stay there, and I haven't sold that many books yet, but I'm thrilled that it's happening. If you're interested in the chapter called in this series course called Careers in Personal Finance, or if you're interested in improving your resume or getting a better job or improving your life, look at that book, Optimizing Your Resume, Proven Techniques for Competitive Situations. I had to get that secondary line done well. Okay, let's move on. Thanks for watching. So last chapter we talked about we talked about credit and borrowing. We talked about some pluses and minuses, debt and getting credit. How do you get credit? Now we're going to talk about different choices, different types of credit, how to calculate your cost, debt, and also a tough topic called bankruptcy. So the best loans are inexpensive ones from parents, family members. Now they have pluses and minuses. There's no doubt about that. Borrowing from family is not always easy, but in the right circumstances, borrowing from family can be the best way, and maybe they won't charge you interest. And so that can be great if you pay it back in a timely way or come up with an agreement that can work out well. Loans that use your assets as collateral, like a home mortgage, investments loans that are collateralized by your investments, life insurance, permanent life insurance that has cash value. There are pluses and minuses, of course, with that too. And interestingly, as I did the research to prepare this, car loans in the last, 10 years, maybe 15, have been reasonable. 0.99%, 1.99%, relatively low. So watch those. I wouldn't categorize those as inexpensive, but watch. Those are probably subsidized by the manufacturer so that the dealers can afford to offer those rates. And watch for the total all-in fees too. It's not just the rate, the interest rate, but also the all-in fees. Medium cost, typical commercial loans from commercial banks, savings and loans, credit unions, the kind of loans that people get regularly all the time. High cost, avoid these. Finance and check cashing companies, credit card, cash advances. I did a cash advance once. Oh my gosh. It was horrible trying to pay it back because you'd make a payment $1,000 and it would pay it back proportionally with the portion you'd use to make purchases and the portion you'd use to get the cash advance. It took a long time and it was very expensive. Don't do cash advances from your credit cards if you can help it. Okay, understanding the cost of credit. The total amount you pay to use credit over the life of the loan, including fees and interest charges. Now, the greatest example of this is a mortgage. Mortgage has a rate. You can look up the rate. Mortgage lender will tell you the rate of interest, 3%, 2.5%, 2.75%, 4.5%. But there are closing costs, $2,000, $5,000, $10,000, more. And those can add to your total cost. That's why a measure like the annual percentage rate, or the APR, is so valuable. It allows you to compare one loan to another on an apples-to-apples basis. It incorporates the cost of the fees too. So you may have two loans that are both 4% loans, but one has greater closing costs than another, or more fees, and so the cost to you is actually greater. Be sure to compare interest rates, the term of the loan, the fees, and the charges. Term meaning the length, 3 years, 5 years, 30 years, right? Watch for variable rates of interest. Now, in the next slide, I'm going to tell you, consider variable rates, but be careful, right? Variable rates can go up when interest rates in the economy at large go up. So be careful. The risk is more on the borrower than on the lender. In a fixed rate environment, the risk is more on the lender, because if interest rates go up, they can't change the loan. So their borrowing costs go up, but they can't pass that on to all their customers. Variable rates allow them to do that. Avoid making the minimum payment on credit cards, right? It increases the length of time that it takes you to pay the borrowed amount back, and it increases your costs greatly. Avoid. Be careful making the minimum payment. If you have to for some period of time, you have kids that went to college, you started a new business, or your business, your job is it's challenging for a time. It happens. Just know though, if you pay 1 month, 2 months, 6 months of minimum payments only, then hit it later when you can and start paying down those costs. Some trade-offs. You will pay a higher total cost if you have a longer loan with a lower payment amount. A longer loan means you're financing longer, and a lower payment amount means you're financing longer. So a lower payment amount may help you if you can't afford a higher amount. If you have to have a house, if you need a new refrigerator, if you have to have a car for transportation, and you've been pragmatic and chosen a practical car and a reasonably priced refrigerator and a home in a moderate neighborhood if you're young or your resources are moderate, then that's all you can do. You have to get the lower payment, but just know that lower payments and longer loans mean more total cost. Ways to lower your interest rate. Provide collateral. Collateral lowers the risk for the lender. That's why your home, if you don't make your payments after 3, 4, 5, 6 months, the bank takes your home, unfortunately. Now, they don't want to keep your home. They're not in the business. They're not real estate people. They're lenders. They want you to borrow and pay back. But if they take collateral, they have less risk, and they can resell your home and repay their loan. Accept a variable rate of interest. There's less risk for the lender that way. If interest rates go up, they don't have to worry that they can't pass their costs on to new customers. Their rate will float up too. Make a larger upfront down payment. You're effectively just borrowing less. You're financing less. Think about a home mortgage where you're putting down 20% down payment versus 50%. There's less risk for the lender. Make a loan for a shorter term, right? You'll likely have higher payments, but you'll have less overall cost. So it's like when you're comparing a 30-year loan, for example, 30-year mortgage to a 15-year. The 15-year has higher payments because you're paying in 180 periods versus a 30-year loan with 360 periods, but you pay less interest. And so you want to do that if you can afford the higher payments. You pay less interest. Simple interest is calculated as the principal amount, the amount you borrow, times the rate, times the time. It's the interest cost. It's the simple interest. This slide is called Calculating Interest and Other Costs. Now that's a very simple calculation, a one-time calculation. It's not what you'll typically see with most loans or with credit cards. There are other ways of calculating, such as declining balance, add-on interest, average daily balance. If knowing exactly how much interest you're going to pay is important, look it up in your credit card statement. Know it in your loan. Know that most home mortgages, for example, are amortizing loans. Each payment has part interest and part principal. Most of the interest is paid up front, very little principal. At the end of the loan, very little interest and a lot of principal is being paid. Credit insurance is designed to pay loans in the event of your death. Normal life insurance will do the same thing. Normal life insurance is generally a better and less expensive choice. And if you're doing life insurance planning, include your debts to be paid back in the case of, in the case of your passing prematurely. Okay. I thought about including this in the last chapter, but I got it in this one. And this is the U.S. consumer debt, total debt and its composition. Now look, this goes from 2003 to 2020. It includes Q4. Actually, it's through 2019. It includes the fourth quarter of 2019. But notice that total debt went up during the financial crisis in 2008, 2009, and went back down again. It kept going up from 2014 to 2019. Now, I think generally our economy was strong then, and my suspicion is that was a normal increase because people were generally borrowing because they were doing better. I think that the pay down following 2008 is because we had hard times. It sounds counterintuitive, right? But when times get tough, look at all the borrowing between 2003 and 2008. Very steep line. Nope, do it this way. Very steep line, right? Like this. And then we hit 2008. We had tough times for 2 years. People began to pay their loans back. And then it went back up again from 2012 or so till the end of 2019. Largest component, home mortgages. So many people in the United States have a home mortgage. In fact, it looks like the total is something like 9 trillion. Now, I don't know what percentage of the U.S. economy that is, but it's large. Notice that in green, auto loans have gone up. Many of you who are students watching this, both undergrad and grad students, notice the red section for student loans gone up considerably since 2003, and for that matter, even since 2008, right? So these are components, and right now, if you look this up, it'll tell you that as of the beginning of 2020, debt was at the highest levels for U.S. consumers that it had been in history, apparently. So positive debt. What is positive debt? Well, if you're using it for important, valuable purposes. Now, there are some people like Dave Ramsey, and I have a slide from him. I have an image taken from his work in the second segment of this chapter. Dave Ramsey says, don't have debt, don't have debt. And he apparently had a crisis when he was younger. He borrowed a lot when he was a young man, 25 or so, to finance purchase of investment real estate, and something happened with his bank. He says, I don't know what that was, but his loans were called, and he said, curled up like a, what do you call that? Fetal position, thinking he was going to lose all of his properties. It was a crisis for him. But he, from that point on, decided he didn't want to have debt. I used to work with high and ultra high net worth clients, average net worth about 20 million. And those people you would think would want to have debt. Most didn't have a lot of personal debt. Many didn't have home mortgages, but some did. And many had business related debt. So, my view is that it's not so much don't have debt, but use it for important purposes and understand how to pay it back and make sure you understand how it works so that you can manage it. A valuable purpose would be a home mortgage, school loan for yourself or your children, a car loan that you need a car for that's affordable. It's in your range. I mean, don't get a high-end, fancy European import when you're 25 years old. That I don't think is valuable or important. But if you need a car to get around, choose a car that has a loan that's appropriate for you, a price that's appropriate for you. And some will debate this. Some will say, no, pay cash. It's a depreciating asset. Buy it used. There's a lot of merit to that thinking, but that's part of another discussion. Starting or investing a business is a valuable and important purpose. Or other thing that you deem important. Things may come up that you think are important or valuable. If you're comfortable paying your bills, if you're paying them in full and on time, taking on debt, maybe you could do. If you know you have an emergency fund, you've already built one. If you're contributing the full amount to a qualified plan like a 401k or an IRA. If you're building and growing your taxable investments, these are your non-qualified plan assets. Positive debt, you could take debt on if it's enhancing your credit score. And last, if you're paying your credit card balances in full or keeping low balances, taking on debt might not be a horrible thing if it's valuable and important. And that's the end of this first segment of the chapter called Credit Source Choices and Debt. I'm Tom Mihawk. You can find me at tommihawk.com, YouTube, my YouTube channel, Resume Optimization, Instagram and Twitter, and also my book, now available at Amazon, called Optimize Your Resume. Thanks. Come on back for the second segment. Be back in a minute.